Welcome to On My Way to Wealth, the podcast where busy Gen Xers can learn financial tips as they navigate life on their way to wealth. And now, please join your host, Luis Rosa.
Hello and welcome to another episode of On My Way to Wealth. My name is Luis Rosa and I'm your host. Interest rates for mortgages are extremely low nowadays. So if you are a homeowner, you might be considering refinancing your mortgage, either to get a lower interest rate or to shorten the term of your loan. Or you might be in the market to purchase a new primary residence or an investment property. Before you do so, I always recommend that you check with anywhere between 2 to 3 lenders so that you can compare their different offers and choose one that is the best for you. Now, you don't want to overdo it because every time that you have your credit ran, applying for credit, you end up having what's called a hard inquiry on your credit report. So you don't want to have too many of these, but if you are shopping around for a mortgage and you have 2 to 3 in the same time frame, that is okay. It's not going to be a significant impact to your credit. You just don't want to go ahead and apply for 14 different mortgages, right? Because that's going to have a negative impact on your credit report. Now, that being said, what I recommend that you do is that you get a loan estimate before you make a decision on whether or not to proceed with that mortgage application. So simply, a loan estimate is just a 3-page form that you receive after you apply for a mortgage. It doesn't mean that your loan is approved, but it is a form that tells you very important details that you need to know in order to make a decision. One of the things that you'll see listed on that good faith estimate, well, good faith estimate was the old name. It's called a loan estimate now. So one of the things that you'll see is the interest rate that you're being quoted. It doesn't necessarily mean that the rate is already guaranteed, but there is a section there that says rate lock, and you'll know whether or not your loan is locked, or if it says no, it isn't, it's just an estimate based on the current environment. You'll also know your monthly payment. It's going to break down the amount of your monthly payment. It'll show how much you pay in principal and interest, how much you pay in mortgage insurance, if anything, and also your escrow, which I'll go into detail in a little bit. Another major thing that it shows is whether or not your loan has a prepayment feature, for example, or a balloon payment as well. So that way you know exactly what you're getting into. So it's a very concise 3-page document that gives you a lot of information that you need to know in order to make a decision on the loan. So it's always a good practice to get a few options, maybe 2 to 3 from 2 different lenders, 2 to 3 different lenders, so that you can then compare. And you'll see why I say that, because the loan estimates are going to vary from lender to lender, and you're able to compare the interest rate being quoted, but also the fees being charged by those lenders. And that comes in very handy before you make a decision. So let's go into the form itself. I want to tell you what the different sections are, what they mean, and how you can use them to your advantage. You don't need to necessarily be following along as you listen, but I will put a link to the consumerfinance.gov that has the actual template for the good faith estimate. And you can use their tool to go page by page to see exactly what every single line item means that you need to know. So the first thing you'll notice on page 1, it says loan estimate. It has the date that it was issued. You're supposed to get one within 3 days after you've applied for a mortgage. So that's something to consider. Some lenders will mail it to you. Some lenders will email it to you or just hand it to you in person if you're there applying for your mortgage. But most of us are probably doing business online anyway. So just be aware that you have 3 days to get this form, and then you can get couple of them, then compare. So the first thing you see, it says loan estimate, date issued, the applicant name, the property, if you already own one. If you're just shopping around and you have not found a home yet, it's not going to have a property address. Has a sales price if it is a purchase. You'll see listed under loan terms, the loan amount, the interest rate, and the monthly principal and interest. And then next to that, it shows whether the amounts can increase after closing. This is very important because back in the day before the 2008 crash, there were a lot of deceptive things that some lenders were doing, or some people just did not understand what they were getting into. So both things played a role in what happened in 2008 with the housing crash and all that. So this form now straight up tells you on that page, can this loan change? Because back in the day, there were people who were getting into a loan that was amortized over 30 years, meaning that you make the payments over 30 years, but the loan was due in 15, or it had an adjustable rate clause where it was fixed for the first 2 years and then it jumped. And some people did not realize that because it said 30-year mortgage. It didn't say 30-year fixed. So they thought they were getting into a 30-year fixed. And then it turns out 2 years later, their payment ballooned, right? So this form tells you, can this amount increase after closing? Yes or no. If you're looking for a fixed payment that doesn't increase as far as your principal and interest is concerned, then you want that answer to be no. Does your interest rate change after closing? Can it increase? You want that answer to be no as well. And then you have your monthly principal and interest. Can that increase? You want that answer to be no as well. Also, right next to where it says loan estimate, it details a summary of the loan term. It says 30 years, for example, if you're getting a 30-year loan, the purpose, whether it's purchase or refinance, the product is going to say fixed rate, adjustable rate, et cetera. So if you're looking for a 30-year fix, you want the loan term to be 30 years, the product to say fixed rate. Has your loan ID. And then very importantly, it also has the loan type. So it shows whether it's a conventional loan, which is a loan that is done traditionally by private lenders, or if it's an FHA loan, or a VA, which is Federal Housing Administration, or the Veteran Affairs. So it tells you the type of loan that it is. And then very importantly, it also tells you what the rate lock is. And that means when you apply for a mortgage and you get quoted an interest rate, it doesn't necessarily mean that you're guaranteed to get that interest rate. Rates change on a daily basis. So at some point, you're going to be asked by the lender, do you want to lock in your rate? And there are different factors of why you would make that decision. Sometimes if people feel like rates are going to get lower as they're applying for their loan, they might do what they call a float and basically not lock it and apply for the mortgage and do all the other things that get done as part of the process, getting the house appraised, et cetera, and then lock it down the line. Or maybe you have a situation where you might be selling a home and buying another one, so you don't want to lock in the rate for the mortgage of the one that you applied for recently because you don't know what's happening with the sale of your house. Or you might have to do a longer term. So typically, the longer you lock in your interest rate, the more that's going to cost you in terms of the fees for your loan. So if I was going to close in 2 weeks, I might just do a 15-day rate lock. Say if I was buying a house and I'm closing in 2, that's going to be a cheaper rate than if I locked it for 30, 45, or 60 days. So that's something you want to speak to your either mortgage broker or banker about so that you know what you're getting into. Because sometimes if you do not close by the rate lock expiration date, that rate has to be extended. And typically there will be fees associated, and you are the borrower. So even if something happened and it wasn't on your end, it could be a delay with title, appraisal, something with the seller. You're still responsible for paying whatever fee that is to extend that rate lock. So you want to make sure that when you do decide, yes, I'm going to lock this rate, that you are going to do so in a time frame that allows you to get everything done on time for you to close, right? So definitely speak to your lender about that. Then moving along, page 1, you're also going to see prepayment penalty. And it's going to say, does the loan have these features? Prepayment penalty, yes or no. And if the answer is yes, you don't see these that often, but that was another thing that happened prior to 2008 where people were getting into these mortgages, not realizing that there was a prepayment penalty. And if rates went down 2 years later, they went to refinance, all of a sudden they had this huge fee that they had to pay before they prepaid the loan, right? Or if they had to sell the house, they were prepaying the loan. So you want that answer to be no. But that form would actually say yes or no. And if it does say yes, it'll tell you as high as X amount if you pay off the loan during the first X amount of years. So you'll know exactly what you're getting into. And then lastly, on the loan term section, it has a statement that says balloon payment and then it'll say yes or no. And this is another issue that happened before 2008. So this form came about just to ensure that this doesn't happen again, so that people know exactly what they're getting into. Had a one, on the front page, everything that you needed to know about that loan. Balloon payment is when a loan has a lump sum that is due at a given time. So for example, you can borrow on a loan, say over a 30-year period. So your payments are based on a 30-year repayment schedule, but the entire lump sum could be due in 15 years. And that would be called a balloon feature. So that's something that you want to be aware of, because you don't want to think that you have a fixed payment for 30 years and then 15 years later, all of a sudden you get this letter and now you have this huge balloon. Again, you don't see these loans that often anymore, but the form explains to you what you're getting into. Then as you go down towards the middle of the page, you have projected payments. And that's going to show you the payment calculation for the loan term. So it's going to say principal and interest. If you have a fixed loan, let's say 20 years, 15 years, it's going to show you the exact number. That should not be any different for the remainder, the entire life of the loan. So make sure that that coincides with what you wanted, right? If you had a fixed loan. Then it shows whether or not you have mortgage insurance. Mortgage insurance is when you put less than 20% down. In addition to your monthly principal and interest payment, the bank is going to require that you pay a mortgage insurance if you put less than 20% down. So it'll say what that number is. And then usually it has a second column that shows when that mortgage insurance period ends. So if your mortgage insurance is going to be through years 1 through 9, then that'll show in column 1, and column 2 will show what the payment is from years 10 to 30, for example. Right. So you'll know when that mortgage insurance is supposed to drop off. Typically, mortgage insurance drops off when the balance of the loan is 78% of the original purchase price of the house, unless you refinance the loan beforehand at 80% or less of the value of the house. So, but typically, if you stay with the same loan, you have to have a period of time go by before you reach 78%, unless you were sending extra principal payments. But ultimately, 78% of the original purchase price, then the mortgage insurance goes away. On the conventional mortgages, it's known as PMI, private mortgage insurance. And on the FHA loans, it's known as MIP, which is mortgage insurance premium. But in essence, it's the same concept. And then the third thing you'll see is the estimated escrow amount. Now, this is an estimate based on what the property taxes are and what the homeowner's insurance is. What most lenders do initially when you first get your mortgage, they set up an escrow account for you where they put 1/12 of whatever the property taxes are and 1/12 of whatever the homeowner's insurance is, and then add that to your monthly mortgage payment. But then they take that portion and put it into an escrow account so that they can pay the thing in full when it's due. So to give you an example, let's say that your property taxes were $2,400 per year. The lender is going to take $200 per month, add that to your monthly mortgage payment. So you have your principal and interest, mortgage insurance if you have any, plus another $200. And let's just say for this example purposes that your homeowner's insurance was $600. So that's $3,000 per year between property taxes and insurance. The lender would take $250 a month, put that in the escrow account, and then the next time the taxes are due or the homeowner's insurance is due, they'll pay it on your behalf. That way you have one monthly payment and the lender takes their principal and interest, applies it to the loan, and then takes the money from the escrow account to pay your taxes and your insurance. That way they make sure that you're always having the home protected and that the property taxes are paid. And then you have closing costs at the very bottom of page 1. So it's going to show you an estimate what the closing costs are, and it gives you a breakdown. If you have any credits, et cetera, on page 2, you will actually see a full breakdown line by line of how they arrived at that figure. And the last line you see on page 1 is the estimated cash to close. So if you're buying a house, it'll show you how much money you need to come with out of pocket on that line, more or less. It should be a pretty close estimate. And then on page 2, you'll see if you have any credits based on any down payment or deposit that you may have already given. If you're doing a refinance, for the most part, some people either refinance to lower the rate or change the term. Some people do a cash out refinance. So if you had money coming to you as part of that, let's say you were doing like a refinance and tap it into your equity, then it will show the amount of money that you're going to be expected at closing as well. So let's go into page 2. Page 2, super important page. It shows the closing cost details. The one that I tell people to really focus on, especially when you're comparing 2 or 3 of these, is the very top left-hand corner where it says loan costs, which is box A. This is what the lenders can truly control. This is their fees right here. They call them origination charges, for example. You'll see fees like an application fee, an underwriting fee, they call them discount points. So, for example, before you do your rate lock, you're given an option. You might say, we can lock it in right now at 3%. Or if you pay 1 discount point, we can give you 2.75%. So a discount point is basically prepaid interest. It's 1% of the loan amount. And they do it in variations. They could do a 1/4 point, 1/2 point, et cetera. It's all based on whatever you're borrowing. So if your loan amount is $300,000 and you're paying 1 point, it's 1% of the loan amount, which is $3,000. And sometimes that makes sense to pay points in order to get a lower interest rate, depending on how long you're going to be in the property, because then there is a certain break-even period that you have to consider. So this is where I tell people really focus on box A when you're comparing loan estimates from different lenders, because this is truly what the lender can control. Origination charges, application fees, underwriting fee. Everything else that we're going to go through now in the loan estimate is going to be an estimate, and lenders typically do the best they possibly can at telling you what those numbers might be. But for the most part, they can't control any of these other boxes. So in order to compare apples to apples, box A is your best shot at it, because then you can truly see what a lender is charging you, whether they have discount fees, application fees, underwriting fees, etc. So box B on page 2, you see services that you cannot shop for. So there are things that you are required to use, but that you're not given an option as to what company is going to do it. For example, your appraisal, the property appraisal. You cannot choose your own property appraiser. The lender will determine that, but you still have to pay for it. But they break that down in box B, like this is the price of the vendor that we use for an appraisal. Same thing with the credit report fee. You get charged a credit report fee because the lender uses a given vendor to run your credit. They get charged the fee and then they just pass it along to you. Same thing with the appraisal. So they have to disclose that to you. You have flood determination fee. So the lender is going to do its own due diligence to see if your property is in a flood zone. That way they know that if in fact your property is in a flood zone, that they're going to require you to have flood insurance, things of that sort. So they're going to list all those fees there that you cannot shop for. There are certain fees that the lender is supposed to be within a 10% margin of error. And if they're higher and they disclose to you the wrong fee within that 10% margin of error, then they're on the hook for the difference. So this should be very close to being accurate as to what you actually pay at the end of your closing. Then you have box C, which is services that you can shop for. And they also break it down and just give you an estimate based on vendors that they use and what the industry is doing at the time. But these are things that you could, in fact, have a say into what vendors you can use for the most part. One of those things is like a pest inspection fee. If you want to do a pest inspection in your house, the lender doesn't require that you use any particular vendor. They'll just give you an estimate and say, oh, this is what our estimate of those fees are based on the current market trends, and then you go ahead and you get your own pest inspection done. Then on box E, you have other costs. Like it says taxes and government fees. These are fees that the county or local municipality is going to charge you. A lot of places do fees based on loan amounts, and a lot of places just have standard fees. It could be even based on how many pages your loan documents are, because some of these documents get recorded with the county. So you're going to get an estimate of what those fees are as well. And then you see on section F, it says prepaids. And these are the things that you're going to prepay in advance. So to give you an example, let's say a prepaid interest. So if you close on the 15th of the month, then you're going to get charged prepaid interest for 15 days from the day that you close until the end of the month at closing, which is why, to give you an example, if you close August 15th, your first monthly mortgage payment is not going to be September 1st. It's going to be October 1st. So at closing, you get charged 15 days from the 15th to the end of August. And then October 1st is going to be charging you for September's interest. So it's kind of like the opposite of rent. Usually when rent's due on the 1st, it's for that particular month. When you're paying your mortgage, you're paying for the past month. And then in Section G, you're going to have the initial escrow payment at closing. So remember how Part 1 showed how much of your monthly payment goes towards your escrow account to pay for taxes and insurance? Sometimes you have a small, or it could be large, depending on where you're buying your property, amount of lump sum that is due at the closing, because depending on the timing of things, if you're closing in July and school taxes are due in September and the current seller hasn't paid those yet, let's say you're buying, then the lender is going to take a nice chunk, at the beginning, because taxes are due immediately, maybe within a month or two. So it depends on when your taxes are due and your homeowner's insurance is due. The lender will take a certain amount of months ahead of time. And then in addition to the monthly payments going forward, in order just to have enough to pay the taxes and the insurance when those things are due. And then Section H, it just has other. So these could be things that could be optional, like if you want to buy an owner's title policy. So speak to your lender about to see if that makes sense for you to do. And then at the bottom right-hand corner, they have pretty much a summary of everything, where they have the total of all the costs. So they show the closing costs, any closing costs that you're financing. Sometimes you can do that depending if you're refinancing, for example, you have that option. Or if you have an upfront mortgage insurance, things like that, so you could finance them into the loan, whether or not you had a down payment or a deposit that shows in there. And then you'll know if you're buying a house, are there any seller credits, any other credits or adjustments? And then if you're buying, it'll show how much money is the estimated cash that you will need to close after they took into account any deposits, seller credits, down payment, et cetera. If you're refinancing, sometimes you might have an out-of-pocket expense, so it'll show there. Or if you're getting cash back because you're doing a cash out refinance, you will also see that in that box, So just a quick recap on pages 1 and 2 is a pretty good summary of what interest rate, your monthly payment breakdown, whether or not there's a balloon, whether or not you have a prepayment penalty, and how much money you have to come out of pocket or you're getting back, right? And then finally, there is page 3 of the loan estimate. Additional information about this loan. These are pretty handy tools as well for comparison purposes. I usually tell people focus on the box towards the middle where it says comparisons. And it just says in 5 years. And then it says use these numbers to compare this loan with other loan options. So it'll show you the total you would have paid in 5 years in principal, interest, mortgage insurance, and loan costs. And also how much principal you will have paid off in the 5 years. Then it shows you the annual percentage rate, APR. Basically, what this does is this is not equal your interest rate. So this is key for you to remember. Your interest rate and your APR are not one and the same. The APR is typically going to be higher because it reflects truly your cost over the long term as a rate. So when you're borrowing money, you might borrow $300,000 on a mortgage, but you might only get $292,000, let's say, because $8,000 were closing costs. So the APR is going to reflect the cost of that interest rate. So what you want to do is when you're comparing, the smaller the gap between your interest rate and your APR, the better. So to give you an example, if you get offered 3% on your mortgage and your APR is 3.25%, right? Compare that to another loan, and let's say same thing, you get offered 3%, but the APR is 3.5. Well, that second one with the 3.5 has a bigger gap, half a point difference between your interest rate and APR. That means that is a more expensive loan. So that's one way where you can do. That's why I always say make sure to compare 2 to 3 of these loan estimates, because then you could truly see what the cost is of that loan. And that way you get a really good estimate from all 3 and a lot of good information for you to make that decision. And that is pretty much it in a nutshell. So if you have a home or on the market for a home, it might be a good time for you to either refinance or get a mortgage right now because interest rates are very low. So just make sure that you compare this loan estimate from 2 to 3 places. Sit down with your financial advisor who can really dive deep into this and do some calculations, do break-even analysis to see if it makes sense to pay any interest points, discount points, etc. And if you haven't already done so, be sure to go to onmywaytowealth.com and sign up for the newsletter. When you do so, you get an ebook, 5 tips that every Gen Xer should be doing now. onmywaytowealth.com. If you have any questions, suggestions, or comments, feel free to send me an email at luis@onmywaytowealth.com. Thank you for listening, and I'll see you on the next episode. Thank you for listening to On My Way to Wealth. If you have any questions, please send me an email at luis@onmywaytowealth.com. The information provided here is for information and education purposes only. The opinions expressed herein are solely those of myself, unless otherwise specifically cited. Material presented is believed to be from reliable sources, and no representations are made by my firm or myself about other parties' information or accuracy or completeness. All information or ideas provided should be discussed in detail with a financial advisor, accountant, or legal counsel prior to implementation. Thank you.